Sharwan Goyal. So it's time.
Right. So the topic given to me is multiply your AUM using smart beta strategies. See, we Indians are cost conscious people. We are so obsessed with cost that leading Indian car company came out with an ad campaign called Kitna Deti Hai, which means what's the mileage? So I'm going to discuss a topic which is in the sense broadly in similar line. So we will talk about passive strategies, and within that we will talk about smart beta strategies. So we believe that Indian consumers are so cost conscious that whenever they are investing or whatever decision that they are taking in life, they look at cost very closely. And passive funds are providing that solution to you. They are providing you cost conscious product at an extremely low cost, but at the same time these are very simple solutions. And I believe that as a distribution fraternity, you can use these smart beta or factor based strategies to acquire new clients. So which means that these could be these products could help you in terms of growing your AUM. When we look at growth of passive funds, we will find that there is substantial growth in passive funds in last 10 years. Size of passive was just about 1% of mutual fund industry's AUM 10 years back, and in last 10 years it has grown from 1% to 17% of mutual fund industry's AUM. We are seeing similar trend whenever FPIs or FIIs investing in India, they are also choosing to invest in passive funds. So about 20-21% holding was there in, for FIIs about 3, 4, 5 years back. At that time, 18% was active and just about 1.5-2% was passive. Overall FI flows have come down, or in the sense overall holdings of FIs have dropped in India, but at the same time their holding in passive is increasing. So which means that the passive trend is catching up both for mutual fund industries as well as FPI money which is flowing through in India. When we look at global parlance, we will find that US market, which is the mother of all markets, more than 50% of AUM is coming into passive funds. So in the sense, about 52% of AUM is passive and 48% is active. It was broadly similar 15 years back where we are now, which is about 17% share of passive. Within passive, there is one set of products which are growing much faster than plain vanilla passive funds, and these are smart beta factor based strategies. So these products are enhanced index strategies wherein they provide combination of active and passive. Because they are passive because they follow the benchmark, they replicate the benchmark. But in an approach, they are active because the portfolio construction is based on certain philosophy. Like for example, quality-based index fund, wherein stocks are selected based on quality parameters. When we look at active funds, they are also follow a certain philosophy. Certain funds follow a quality approach, certain funds follow value approach, certain funds follow momentum approach. So in the sense, active funds also follow these approach. But passive funds are rule based. So which means that based on certain rules, portfolio is constructed. And we are seeing these kind of products growing much faster in India in last few years. It's not correct. Present this please.
Presentation.
Can you connect present? So within passive funds, we are seeing that smart beta funds are growing much faster as compared to plain vanilla passive funds. So these passive funds, which provides differentiated offering, they are growing much faster. So size of smart beta was just about 1% of index fund about 3 years back, but they have grown to 16-17%. So in a sense, overall growth is much faster in this space as compared to overall passive fund space. So let me talk about these factor-based smart beta strategies. There are 4 broad factor-based smart beta strategies: momentum, low volatility, quality, and value. On left hand side, we have momentum and low vol. These are more of market-oriented factors because portfolio is constructed based on price performance. In case of momentum, a portfolio is constructed of companies which are performing much better than other companies. So based on last 6 months and 1 year performance, companies which are showing very strong price momentum, a portfolio is created of such companies in case of momentum strategies. While low volatility strategy is basically counterbalancing to momentum. Whenever market is going through difficult phase, so for example, in last 1 year we have seen market is extremely volatile. In such market environment, this strategy helps you generate much better outcome or provide a lot of protection to the portfolio. So in the sense, generally combination of momentum and low vol works much better, because whenever market environment is conducive, generally momentum will work well. But whenever market is going through tough phase, in that phase, low volatility strategy will provide you a lot of protection. So in the sense, combination of these two products provides much stable outcome from long-term perspective. On right hand side, we have quality and value. These are more of a fundamental factors, just like active funds which follow either quality biased approach or value biased approach. But here you get pure play quality or pure play value portfolio, because these are rule-based portfolio. When I talk about quality, so based on quality parameters like high ROE, low debt to equity ratio, and consistency of EPS growth over last 5 years, you construct a portfolio which is extremely quality oriented. While when it comes to active funds, they follow certain degree of quality or value approach. So they don't give you full flavor of either quality or value. So that's the advantage of factor-based smart beta strategies. If you believe that quality cycle is likely to play out over next 2-3 years, you can choose to invest in passive funds which are quality oriented, because you don't have to worry whether portfolio manager is actually following quality approach or not, so which is getting sold through this particular process. Similarly, value strategy, in case of value strategy, companies are selected based on their valuation. So based on traditional valuation methods like price to earning ratio, price to book value ratio, dividend yield. So based on these parameters, companies are selected, and this particular product offers you a portfolio which is value oriented. Typically, value style performs much better during macroeconomic recovery. So post pandemic, we have seen that there was very strong macroeconomic recovery in India, and in such phase, value portfolio has done much better than any other style in the marketplace. Next slide, please. Next slide, please. Right. When we look at performance of these factors from long-term perspective, then we will find that all these factors, be it momentum, low vol, quality and value, from longer-term perspective, all these 4 factors have done much better than broader market. BSE 200, which is top 200 companies listed in BSE, has delivered about 15% return, but all these factor-based strategies have delivered much better outcome as compared to broader market from long-term perspective. So which means approach which is based on these factor-based strategies have helped you generate much better outcome from longer-term perspective. But when we look at annual performance, next slide please. So in the sense, winners keep rotating. It's not that all the factors keep on performing on yearly basis or short-term perspective. There are certain cycles which are favoring one factor or certain cycles which favor other factors. Can we move to next slide please? Next slide. Right, this one. So on yearly basis, winners keep rotating. One particular cycle may favor quality oriented approach, one cycle may follow or support value oriented approach. But from broader perspective, consistency of these factors from longer term perspective is much better. So post pandemic, from FY21 onwards, we were seeing value cycle playing much better than quality cycle, and from FY21 to FY25, in last 5 years, value cycle has played out very well, and in last 5 years, value is the best performing strategy on consistent basis. But prior to this period, pre-pandemic, from FY17 to 20 period, these three, the value style was one of the weakest style as well. So among all these factors, value is extremely cyclical. Other cycles or other styles are much more stable as compared to value. But from longer term perspective, in sense, hit rate of these factors is much better than broader market. So in the bottom table, we have mentioned how many years or what is the percentage of times when a particular factor is performing much better than other factors. So BSE 200 is ranked 1 or 2, 20% of the time. So 4 out of 20 years, BSE 200 has been the best performing strategy, ranked 1 or 2. But other factors are having much better hit rate of about 40 to 50% on yearly basis. Next slide, please. Value style performs much better during market rallies. So here for that we have dissected BSE 200 returns on 1 year rolling basis, and we have dissected based on market returns. The first is when market returns are negative. Second one is 10% bucket. So the broader trend that you can see is on last 4 columns, which is alpha versus BSE 200. Momentum is one of the most consistent style from longer term perspective, because on an average, whether markets are bullish or bearish, on an average it is generating alpha as compared to broader market. While low volatility in quality style perform much better during tight equity market environments. Whenever market trends are either negative or range bound, in these phases, these two styles are performing much better. While value is just opposite of quality and low vol, because it is performing much better during market rallies. So whenever market returns are in excess of 20%, in that time period, value style performs much better. So post-pandemic, we have seen that markets have recovered from low levels, and because of very strong rally in the marketplace, we have seen value style playing very well in last 3 to 5 year period. Next. Caught in this dichotomy that we end up investing in best performing scheme, but because of low persistency of these funds, next 3-5 year period, another set of schemes perform better. So understanding the cycles of these factors is extremely crucial, and you can use this particular knowledge for selection of active funds as well. So based on the cycles of these factors, we look at how cycles play out, and then based on common link across these factors in last 20-30 years period, we have decided value inflection zone and quality inflection zone, and basis that we decide allocation across these factors in our fund. So suffice to say that we follow mean reversion characteristics, that if a particular style has performed well for last 2-3 years in a certain proportion, then in a proactive manner we invest in other style, because that style becomes cheaper because of underperformance in 2-3 year period. So broadly we follow value inflection zone and quality inflection zone based on performance of these factors, valuations of these factors, earnings growth of these factors, and accordingly decide where to invest. Similarly, between momentum and low vol also there is extreme cycle, and basis that we take a call whether to invest in momentum or low vol. This is last 20 years year-end allocation of allocation across these factors based on backtested results. So our model started signaling allocation towards quality about 18 months back. So for last 18 months or so, we are investing heavily into quality-oriented companies in our portfolio.